13% per year. That's how well the S&P 500 has performed over the past 10 years. If we add up all those 13% and we look at the total return cumulatively for the past 10 years, it's almost 200%, which means that the S&P 500 today is worth 3 times what it was back in 2015. 10 years, honestly, is a very long time. It's about 1/5 of someone's entire investing career. When the S&P 500 performs that well on average for 10 years, I think it's normal to start hearing voices out there saying that you can't lose by investing in the S&P. Just buy the S&P. How many times have you heard this? Just buy the S&P. Don't think, just buy the S&P. From where we are today and the decade we just had, the S&P feels like a very sure thing, a very reliable way to make good returns without overthinking too much and doing too much research and without taking on too much risk. The question that everyone is asking now is, how long can this continue? And as you very well may know, there's no shortage of predictions out there and people giving hot takes as to where they think the S&P will be next year or within 5 to 10 years. But when a bank that's globally renowned like Goldman Sachs talks and publishes a report, it's usually a good idea to read just to see what they have to say. And Goldman Sachs made quite a splash when in October 18th of 2024, they released this paper, this prediction, saying that they only expected the S&P to have a 3% annual return for the next decade. Now, keep in mind that 3% is the nominal return, so that doesn't include inflation. If we take inflation to be around 2 to 3%, that brings the real S&P returns down to 1% or 0%, which at face value is not all that great. So in this video, what we'll be doing is diving into this paper and looking at how Goldman Sachs came up with this prediction, what factors are they taking into account, and then I'll be finishing by giving my thoughts and what I'm going to do based on this paper. First of all, the return that Goldman Sachs is predicting is 3%, but keep in mind that 3% is just the baseline. Usually, when it comes to investing and people trying to make forecasts, the best way to think about it is in terms of probabilities. And you should be doing the same thing with your own investments. When you try to, think of outcomes for specific companies, and you're looking into the future and trying to decide, okay, how fast are they going to grow their earnings per share or whatnot? It shouldn't be a yes or a no, black or white. It should always be in terms of probabilities. Because at the end, the future is unknown. And so the best thing to do is always to make sure we're okay with any type of scenario. So bring that back to Goldman Sachs. Yes, 3% is their baseline prediction for the next decade. But there's actually a range of probabilities. And what Goldman Sachs deems to be the range of potential returns is from 1% at the bottom end to 7% at the upper end. And yes, that is quite a wide range. If you were critical of this paper, you could say, well, if I predict 0% to 15%, I'm bound to be correct. That would be a harsh criticism, but, fair enough. I think the main thing to keep in mind here is that even at the higher end of the prediction, so if we take 7%, that's still quite lower than what we've seen in the past decade, the 13%. So Goldman Sachs is sending a pretty strong message here and saying that the returns for the next decade will probably not be the same ones that we saw for the past decade. And here we have a chart of the history of the previous 10-year returns of the S&P 500. And we can see that we're at a high end here, 13%. That's where we were around the 1990s and the 1950s. It's not the highest that we've ever seen, but it's kind of up there. Something else to note too is that usually after periods of really strong returns like the 50s and the 90s, what we tend to see is a downward trend that comes all the way down to close to zero. And so in the 70s, we saw a period of nearly a decade of close to zero returns. And at the end of the 2000s, close to the Great Financial Recession, of course, that famous decade was negative returns. One more piece of context that I need to go over before we dive into Goldman Sachs calculation and what factors they looked at is where the returns in the stock market come from. Now, as you'll know, the returns of any stock price come from two separate factors. The first one is the earnings per share growth. The second one is valuation. So let's take that first one, earnings per share. I, for one, prefer free cash flow, but for the sake of this argument, both of them are the same. If a company increases its earnings per share, then naturally the value of those shares becomes higher. If we look at the second aspect, which is the valuation, all that means is now investors are willing to pay more for a given earnings, and so the price of the stock goes up. If you're a fan of Charlie Munger and Warren Buffett, you'll know that over the very, very, very long term, earnings per share growth, that number one factor that contributes to the stock price, is way more important than the valuation. Why is that? Well, valuation has a natural ceiling. Once you get to paying 30, 40, 50 times the earnings per share, you get to a point where you're on the high end of what people are willing to pay for a stock to have a decent return. But earnings per share has no ceiling, A company can keep growing its earnings and its free cash flow for decades and decades and decades. So having said that, if we look at the previous decades, so from 2014 to 2024, this is how the returns came to be. So dividends contributed to about 1/4 of those returns. Out of the remaining 3/4, 3/4 of that came from EPS growth, and then 1/4 of that came from valuation expansion. Just as a little bracket, this is why I like to focus on quality dividend paying stocks, because as you can see, even during a decade where returns have been extraordinarily good, dividends and EPS growth contributed to the majority of those returns. And so if you focus on dividend paying companies that have a good dividend and that are high quality, which means they have a moat and they are highly profitable and they're growing their cash flows and they have low risk, then you're lowering your own investment risk by quite a bit. In this study, to come up with a 3% return over the next decade prediction, Goldman Sachs looked at 5 factors, which are valuation, economic fundamentals, interest rates, market concentration, and profitability. And right now, we're going to go through each and every one of those in more detail. Goldman Sachs used the CAPE, or cyclically adjusted PE ratio, as their metric for valuation. And for those of you that don't know, the CAPE is just an average of the earnings of the past 10 years. So instead of just looking at a PE ratio, which is right here and right now, what are the price relative to the earnings, it looks at the earnings over the past 10 years and adjusted for inflation. In the chart here, we can see that today we are at a CAPE of 38 times, which is the second highest of all time since 1930. And Goldman Sachs themselves put it really well here. In theory, a high starting price, all else equal, implies a lower forward return. That just makes sense to me, at least. All else being equal, I rather pay 10 times or 20 times rather than 38 times. And the higher you pay for a given earnings, the lower your return. That's just mathematical. Like I said before, it's very hard to predict the future, but what we do know is that when you invested in 1980 at a 10 times multiple on the CAPE ratio, you were just setting yourself up for success at that point. Now, when it comes to today at 38 times, a lot more things need to go right in order for you to have a really good return investing at this level. But like Goldman Sachs say themselves in this study, the valuation at the end of the day has to be taken within context, within the broader context of the investment period. What do I mean by context? Well, we have to look at the constituents of the index and we have to look at the broader economic environment. Let's do both of those things. If we look at the constituents, it makes sense to pay more for quality, right? That's something I always preach on my channel. And what's one of the measures of quality? Well, it's the return metrics, the ROIC, ROCE, which I use on Rated A, or, they use ROE, the return on equity in this paper. The truth is, most of the top companies in the S&P 500 are very high quality companies, the Apples, the Microsofts, the Googles, the Metas. All of these companies know how to make money. They print money, and their ROEs, their return on equity, is just really, really high compared to average companies in previous eras. And so when you take that into account, it makes sense that, the CAPE ratio for the S&P 500 should be higher today relative to the 1980s or the 1990s. The second thing, the broader economic context is interest rates. And let's be honest, since 2008 and maybe even before that, interest rates have been near zero. And even after, going up so much in 2022, today the interest rate is at about 4%, 4.5%. If you look at that in the context of, the history of interest rates, that's still quite a low level. In addition, a lot of people are forecasting the interest rates to come down. And as a matter of fact, they've already started to come down. Like Warren Buffett always says, interest rates are gravity for stock prices and index prices. It's just easier to make money when the cost of debt is really low. So yes, today the valuation of 38 is insanely high relative to, the broader historical context. But we also need to take into account, the quality of the companies and the interest rates from the Fed and the Bank of England and all that stuff. The second factor that Goldman Sachs mentions, and this factor is actually the drag on, the expected returns. This is the market concentration. Simply put, the market has never been this concentrated since the invention of the S&P 500. Today, the market cap of the 10 largest S&P 500 companies as share of the index total is 36%. So every time you dollar cost average into the S&P 500, most of your money, well, 36%, which is close to 40%, goes into the top 10 companies. And we all know them: Apple, Microsoft, Eli Lilly, Amazon, Facebook, all those. So why is having such a concentrated market a drag on future returns? Goldman Sachs puts this down to two main reasons. The first is volatility. The more concentrated the S&P 500 gets, the more volatile it will also get. This makes sense. If we take a basket of 100 stocks, and assuming that all of them are quite uncorrelated from each other, if there's an economic recession, maybe some stocks do well, some stocks do poorly. That's the point of having a basket of 100 stocks, so that you have a well-diversified portfolio, right? Now, imagine that out of those 100 stocks, one stock accounts for 99% of the value of the basket. At that point, it's very easy to see how the returns of that one stock would pretty much determine the returns for the entire basket. Remember, that stock is 99% of the entire basket. It's very logical that the returns of one single company will be more volatile than a basket of 100 companies. This is not to say that the S&P is that concentrated, but just to illustrate the point that the more concentrated you get, the more volatile you become. Volatility just means that, it goes up a lot and it goes down a lot. In the past decade, it's been going up a lot, so who knows? And maybe in the next decade, it'll come down a lot. Myself, I don't really care about volatility. A lot of people see volatility as a measure of risk. Me, I think that permanent destruction of capital is actual risk. I don't see a stock price going up and down as risk. Psychological risk, maybe, because it is harder to hold in your portfolio a stock that goes up 30% and down 30% every day. But that's another story. The second reason why market concentration leads to lower returns is just growth and the law of large numbers. As companies become larger and larger, it gets harder to get, high levels of growth. It's very hard to imagine a trillion-dollar company doubling every single year. Mathematically, that just doesn't make sense when you compare to the GDP of a country, of an economy, or of the whole world. If we go to much smaller companies, like a billion-dollar company or $500 million company of market cap, then it gets much easier to imagine that a company could double every single year for a decade, for example. So that being said, when a company becomes so big and so important to the global economy like Microsoft or like Apple, it takes a huge amount of growth and of extra earnings to even get 1% of growth or 2% of growth. And so when you think about it that way, it makes sense why a market that is very highly concentrated would see lower growth. Because at that point, the basket of stocks in the S&P is more reliant on a small group of very large companies that will have more trouble growing at a fast rate. A chart that I find very interesting is this one here. As a group, the top 10 largest stocks in the S&P 500 have a multiple, a PE multiple of 31 times. If you remove those 10 very large companies and very important companies from the S&P 500, the rest of the S&P has a PE of 19, which sounds a lot more reasonable. But if you look at today's S&P 500, the multiple is actually around 27, 28. And that's because the top 10 companies are so important that they just pull the average upwards. But when you buy the S&P 500, you're buying these companies and these companies. Something very important that Goldman Sachs mentions here is government regulation was one reason why previous generations of superstar firms eventually experienced slower growth and lower valuations. And here they give the example of IBM, AT&T, and Microsoft. Now, of course, for two of those, IBM and Microsoft, the lawsuits were dropped and, these companies were never broken up like AT&T was. Nevertheless, these lawsuits still ended up slowing the growth and lowering the valuations. If we bring this forward to today, we can see that the DOJ, the Department of Justice, is coming after America's giant and super profitable companies like Google and Apple. Imagine if YouTube had to be competing on its own without all the funding from the Google search. Imagine if Waymo had to be competing on its own against Uber without funding from Google search and YouTube. It's a lot harder for smaller and mid-sized companies to compete when your opponent is a company like Google. All that to say, this is another possibility among all the other ones that we have to consider. So until now, we've talked about the CAPE ratio, which is valuation. We've talked about market concentration, and we briefly mentioned interest rates and the return on equity. The final factor that Goldman Sachs considered in this study was the economic contraction frequency. I'm not going to dwell too long on this one because I think it's more arbitrary than anything. What they did is they looked at the historical context and they predicted in how many quarters on average there would be an economic recession or a contraction. So there we have it. That's pretty much the entire study. If we compare Goldman Sachs' prediction of 3% baseline returns to the prediction of other similar big banks, Goldman Sachs is clearly a laggard by quite a bit. On average, most banks predict a 6% return over the coming decade, which is double what Goldman Sachs is predicting, but still way off the 13% that we've been living through in the past decade. So I think the consensus is that everyone thinks that 13% won't happen again. So what's the point of all of this? What's the point of reading Goldman Sachs predictions, of studying the market, of reading forecasts, etc.? Personally, I really couldn't care less about forecasts for many different reasons. One of them is that all these people that work at banks, they're incentivized to forecast good returns in order to bring them business. But beyond all that, the main reason is because the future is unpredictable. I think the main point is to understand that 3% returns for the next decade is a real possibility. And to get out of your comfort zone of thinking that stocks only go up, that the S&P 500 is super safe and only ever goes up, and that it's investing on easy mode. What do you think would happen if we had a decade of 0% or 3% returns? Do you think most people would still be dollar cost averaging every month with conviction? Maybe, maybe not. The point is that great returns are never guaranteed. If you know that the future is unpredictable and you let yourself be surprised by whatever the market does to the upside or the downside, then you already have a competitive advantage as an individual investor because that forces you not to predict, not to time the market, and to think long term. It forces you to think differently and to invest in a way that you'll be fine no matter what happens to the market. Remember, Warren Buffett's number one rule is never lose money. What that means is being defensive no matter what, whether times are good or times are bad, be prepared for bad times. And if you're defensive and if you're prepared for the worst and you stay alive and never lose the majority of your nest egg, then naturally the returns just take care of themselves. That's why people say that time in the market beats timing the market. Staying long and staying invested for, decades on decades on decades, even if you get slightly lower returns, then you'll achieve really great things. If you start to chase those returns and actively try to get 15-20% per year, that's when you're setting yourself up for 60-70% drawdowns in your portfolio. And that's what really kills the compounding process over the long term. So, what am I doing personally? The truth is nothing. I'm going to stick to my dividend stocks, my high quality dividend stocks. I'm going to focus on buying and finding companies that have great competitive advantages, that are highly profitable, and that will likely grow their cash flows well into the future, and that have less exposure to risk. Those are the companies that will grow their EPS again and again and again, and that produce that compounding curve. And of course, buying those companies at the right price. That's why I have the quality ratings and the value ratings. If you want access to my entire portfolio and all of the positions and the allocations and the dollar amounts and the average price at which I bought all these shares, all of it is available on the Rated A platform. That's rateda.co. I'll leave the link in the description below. You'll also have access to a growing list of high quality dividend paying companies that I analyze myself based on all the important metrics like the moat, the profitability, and the safety that I keep mentioning in all these videos. And you'll get a bunch of financials and a lot of really cool features. So sign up if you want to try it. It's free for 7 days and you can cancel anytime. So there's really no risk. At the end of the day, I don't care what happens to the market. I am not buying the entire market. What I care are individual, specific companies. I look at company fundamentals, and that's what I focus on. I don't care if the market as a whole goes up 3% over the next decade, because I want to find companies that will grow 10% over the next decade. To me, the market is just noise. The more people end up focusing on the wrong things like the market, the better for me. That's it for this video, guys. I hope it was insightful, and I'll see you in the next one.